Hi, good evening. How are you? Today, I'm going to cover IRA retirement saving strategies, how to choose retirement funds and annuities. And everyone, I'm Helen Zhang. Here's some information about myself. I'm a CPA and also certified HR professional. And in my experience, I have worked in the Fortune 500 companies, also worked in higher ed. Currently, I'm an accountant at HZ CPAs and Advisor. And in my interest, I conduct training in management accounting, business startup, team management, family finance, tax, education services, and so on. So I love to provide accounting and tax services. And today I'm going to cover personal goals, IRA strategies, tax savings, 401k, 403b, and IRA rollover. First of all, let's take a look at personal goals. Everybody think about, in my retirement, there are a lot of things I would like to do. And I heard people talking about, yep, I love to travel, spending time with grandchildren, and potentially I can just sleep whenever I want it. And now I've got tons of time to do my hobbies. That all sounds fantastic, but here is the core. Do we have enough money? How about the US Social Security benefits? Are they sustainable? Do we have enough money to support the rest of retirement life? So during the retirement stage, usually we have three phases. The first phase is go-go years. That's a golden time, which right after all the years of work, you'll be able to do a lot of things. And it's very active time. You'll be able to travel, visit family, doing lots of things normally you didn't have time to do. And during the second decade, that's a slow go years. And slow go years, and we're slowing down and really shrinking the travel time. And lastly, in the third decade, that's no-go years. That is about everyone's retirement. So during the retirement time, our spending of habits have changed. We will spend less time and less money in household spending. Also, the house expenses, more than likely, a house has been paid off. However, looking at the medical expenses, the healthcare, the costs have gone up dramatically. So if you look at historical inflation in the United States, and inflation has been really high during history time. In the most decades, during the COVID time, the inflation has reached double digits. And we can tell that it used to be $20, we'll be able to purchase a lot. And then now with $20, we really can't buy much. So if you calculate when the inflation is at 3%, the current living cost is 100K, which means in 20 years' time, it's going to be costing us 180K. When the inflation rate is at 4.5%, and that will mean that we need 240K in 20 years later. So let's take a look at long-term care needs. What would be long-term care? And if any person for any of those two activities, they will not be able to perform, and this person requires long-term care. In the United States, about every 5-6 Americans, there would be one person who requires long-term care. And that long-term care may cost a lot and also a length of time. So let's take a look at the cost. In 2016, the cost per month for long-term care, it was about $7,600. For this level of care in 2036, that will be reaching $14,000. Well, in 2056, this cost essentially will be 4 times of what we would pay in 2016. So think about if length of time of care is required, and we really need to have much larger saving in order to cover the long-term care. When we think about retirement, no matter what stage of life you're in, and the retirement, you would consider how much do we need the money for. Basically, there is a rule of thumb. That's the 4% rule. So how does that work? If you look at your current lifestyle, your spending per year, if you currently spend about $50,000 per year, which essentially means that you need $1.25 million when you retire. That is using 50,000 divided by 4%. Well, if your lifestyle is slightly more expensive, if you need 75,000 to live, And that lifestyle requires you to have $1.8 million down the road to retire. So you can either compare your retirement income or expenses by using a couple of those stories or calculator, and that gives you a story, depends on what age you're at. If you're fairly young, only 21 years old, you plan to retire at 67. Depends on how much money you earn, you can write up your story, look at how much money you have saved and how much money you need. And when you do that calculation, that shows you how much money you would need per month. Likewise, when we have this 4.4% rule, we can take a look at this to do a quick calculation and looking at, well, depends on age, how much money you have already saved, and when you would like to retire, we'll be able to shift this, depends on your asset currently. You can do a various kind of calculation, looking at how much money you would need when you retire. So now, let's think about retirement time. During retirement, it's more important, we need to have more fixed and stable income to make the guarantee work for us versus the investment expose much higher risks. So you want to reduce this high risk investment during the retirement time, however, to increase the fixed and stable income. So with that, here's a strategy. That is annuity. Annuity is a good way that helps us to accumulate the money while we're younger, while we were working, and we can accumulate money as we go. And that money, when we reach to retirement, can have this lifetime income. We can liquidate this investment, which will accumulate year over the year. So there are several ways of this annuity, and you could have the single premium by rolling over a pot of money, or you can have immediate annuity. Sometimes when we look at our individual retirement accounts, that is your accumulated retirements accumulation. So all in all, annuity is a really good solution for all of us to expect this lifelong income just to make sure that we have enough savings to have this quality retirement life. And that is a good way to make up this shortage of 401k when we didn't save enough money. So now I'm moving on to this IRA strategies. So IRA strategies, we can use this strategy to help with both individual as well as a business. So for the individual perspective, we have this traditional IRA or Roth IRA. It truly depends on whether it's deduction for the tax needed or not. For the business perspective, that depends on whether it's matched by the employer or not. And we can look into whether it's a simple IRA, which is a salary deduction, or it's a SEP IRA, it's employer only. So today I'm going to look into the business for the SEP IRA only, as well as looking at individual perspective. So first, let's take a look at this individual. Between traditional IRA versus Roth IRA. Traditional, that is tax advantage savings with the pre-tax money, but it will be taxed when we withdraw the money later on. For the Roth IRAs, that is after-tax money to save, and future growth will be tax-free. So in looking at it, it really depends on, would you pay the tax at the seed stage, or would you pay the tax at a harvest stage? And looking into this, just for example, if we earn 80K now, future-wise, we earn 50K. So the IRA savings for the traditional perspective, if for now, we don't have to pay tax for this amount, that'll be tax deductible. However, when we withdraw the money in the future, if we withdraw $5,000, and for the future perspective, we need to pay for the tax when we withdraw it. On the other hand, for the Roth IRA, that is the after-tax saving. So for example, now we're still doing the savings, right? But our taxable income stays the same, which is equal to our annual income. But when we have the growth, whatever the money has grown over the years and time horizon, for the future withdrawal, all the growth will be tax-free. So let's take a look at what the difference is on the small details. And anyone, whoever has active income, they can open up an account to open either traditional IRA or Roth IRA. And if the couple files jointly, the non-working spouse can open his or her own traditional IRA or Roth IRA. Lots of families do not know this, particularly if we do have a stay-at-home dad or stay-at-home mom. This is a really good way. It's something you'll be able to save. Well, even you don't have this active income from a company also. So for this year, our contribution limit has been increased as well. And under year 50, the contribution limit is $7,000, but over 50 years old, the contribution limit is $8,000. For the traditional IRA, there is required minimum distribution after age 72, and otherwise there will be a penalty. At the end of the day, you don't want to use this as an asset planning tool. Well, for Roth IRA, which doesn't have this required minimum distribution limit, if we really need money earlier, prior to 59.5 years old, there will be a tax penalty. So when you save the money, we really need to look at all these tax strategies, tips, and looking at whether we have those flexible money in order to save this. But no matter what, IRA is a great way for American citizens, residents to really consider your retirement early and have a good way to plan out your retirement. If you hear some stories, an IRA can be saved in individual stock, real estate, mutual fund, annuity, and so on. And one of these very smart alumni who used the Roth IRA, when he had this startup company, he used the IRA to invest in his own company stock. And guess what? Because of this tax strategy, his IRA has grown dramatically because his company went IPO later on. And so all his savings into these millions reaching multi-millions becomes tax-free down the road. So I also want to talk about this custodial IRA. Clearly, just as the name says, it is something for young kids, for minors. And if you do have kids who are working, earning any income, or potentially if they're doing babysitting work and go after for cashier work, or potentially even they're really, really smart, earning scholarship, getting awards, all those money the child earns, and we can report the tax, file the tax, and then we're eligible to save money for the child. And the child can be as young as 1 year old, 2 year old to do the ads for the TV. All can be, reaching 17, 18, who is working for part-time job. But no matter what, for this is a good way, and you'll be able to open up this custodial IRA and help the kids start saving for retirement at early stage, with a time for the long run. And for this, and the kid will be able to see a really good way for the saving for his or her retirement down the road. So one tip is that for the child, we have to look at how much money the child has earned. For example, if your daughter earns $4,000 as a lifeguard, she can only contribute up to $4,000 to her custodial Roth IRA this year. Even the limit is higher, it truly depends on how much she has earned this year. So if your child has earned any active income, don't miss this opportunity, because truly this is way beyond a toy, a gift, whatever you give to the child. It is a way to show them how to save during the years, and they will be able to have a fantastic retirement lifestyle for the long run. So now I would like to run an illustration for you. This is for a young adult, a college kid who just started working. He started saving IRAs when he is 20 years old. And he saves about $6,500, as this was calculated from last year. And he saves $6,500 year on year. And when he reaches retirement time, so this money in annuity form, which is 125 and beyond, 125,000 beyond, tax-free as this Roth IRA. Remember, this is the annuity type, which means that some small money you save on accumulated basis, this money can really have a great return for you. And you have the tax strategy, they're all tax-free when you withdraw it. And not only that, look at this death benefit column. Because of the time horizon, you not only save money, you also have generated wealth. So no matter what, this is really good habit. 6,500, what does that mean? It means that about $600, $500 per month, $20 per day. It is just one meal for either lunch or dinner. So I also want to mention about the IRA income limit. And for the family who do not earn income more than 218, they're eligible to save IRA. However, if the family income over 218,000, there would be some other strategies other than IRA. So if you do file just as a single head of a household or married filing separately, the limit reduces to 138K. All right, so I do hear people talking about, well, I wish I knew there was IRA. I wish I knew while I was younger, I should have saved way earlier, but their salary reaches way higher when their their salary has gone up a lot. Now they don't have this eligibility to save IRA. Now, I want to talk about Roth IRA advantages versus traditional IRA. As earlier, I did talk about some of them, but I want to point to you. First of all, Roth IRA doesn't have the required minimum distribution. As long as you live, you can really save the money up there. Secondly, there is no age limit. You can put money in your account for as many years as you want. And so basically, as young as you are or as senior as you are, you'll be able to put money into the account. Plus, there is no employer plan restrictions. It's not like, 401k or 403b. As long as you don't exceed the income limit, you can contribute to whatever way as you need. And this can help if you really want to have estate planning tool. It's another tool to handle it. Lastly, remember, Roth IRA is tax-free product, which means that you can pass your Roth IRA to your beneficiaries. And when they withdraw, it will be tax-free. Okay, so when you convert your IRA into Roth, what will be some factors to consider? Either first, that will be how much money, what will be your IRA investment? Secondly, you need to consider what's your current tax rate versus what's potentially your future tax rate. Lastly, how long you're going to have the money, therefore, what's the time horizon and what would be your risk toleration would be. So let's take a look at some calculator. This is from the company Charles Schwab. And you can take a look at, hey, what would be your current IRA? For example, if we're transferring 100K up there, you can take a look at, I'm going to transfer the entire amount. And your filing status, let's just say for single perspective. And if you do estimate taxable income, let's say I'm earning about 80K. So your income rate at the first withdrawal. So we do some calculation and understand what it really means and just put down as 20% for now. And you're looking at maybe which year you're transferring it. Maybe I would like to retire in 20 or 25 years. I'm putting on 25 years for now. And depends on my risk profile, my expected rate, my return for IRA investments. So more than likely, I'm probably moderately conservative, etc. Now we can do a calculation. So that gives you a kind of idea, hypothetical perspective. If you had money into your traditional, or if you had money converted to Roth IRA, also depends on during the year and whether you're going to have some loss. If you wish to have offset your IRA, you can look at, because whenever you convert your traditional IRA, you have to pay tax when you convert. So we have to evaluate the situation, find a year, and also find a strategy if you truly want to convert it. Once we work out through the strategies, and if we're at early younger years, maybe convert to all the Roth IRAs makes best sense. So that gives you all this explanation, also talking about impact of the future tax bracket. Okay, coming back to where we're at. Now I want to move on to the small business tax saving tools. So the small business tax saving tools first. 14 states Retirement Enhancement Act has required small businesses to get retirement benefits for the employees. And this is particularly for the self-employed or small business owners. And this is a really good way to retain your employee, also have the great benefit and retirement, save the money for your employees. So if we do this simplified employee pension, first, that's employer funded, and we have to do contribute IRAs for all, not for one or two. So when we have the small companies, either a just like husband and wife company or several of the family business members, whatever, and when you look at the situation, that will make sense if you save as SEP IRA, because that might be a way to help you to have the money keep with you versus pay the tax during the year. So the eligible employees for this category, that'll be 20 years age or older, also who at least earned $600 in the past year. And employers can take tax deduction because these can be deemed as a cost of running business. So the employer contribution, there is a threshold. That would be you compare either 25% of individual salary or the maximum at 69,000, whichever is less. That's the new limit for 2024. And we can contribute this SEP IRA with a traditional or Roth as, in addition to it. So now let's take a look at the 401k. Actually, before I move on, I want to run an illustration for you. How does that work? So for example, for a company, now let's take a look at if a small company's net business profits. And I'm using this 2023 example for now. If this company has earned profit as 50,000, and when we do the self-employment tax, and so the really adjusted net business profits will be the differences between the two numbers. The contribution percentage as 25%, or we look at this adjustment earned income, which is the adjusted net profits adjusted by the contribution factor out there. When we compare looking at maximum earned income, and that will be 330,000 for 2023. So the final earned income, we use this as whichever is less, right? So with that, our contribution amount, which is we use this 25% of this final earned income, that helps us to contribute into the SEP IRA. And then with that, what does that mean? Our profit has been reduced by the contribution amount, and then we need to pay less tax to IRS during the year. The money has been kept with the company employee during the year. It's another way to save tax liability, also save the money for the retirement. Now, let's move back to our presentation. So next topic, I'm going to talk about 401k and 403b rollover. When you consider rollover, there are several ways to handle it. One of them is just guaranteed fixed index annuity. Another one is fixed index annuity with growth. Let's run some examples. This is one of the companies which provides annuity products. So for an individual who is 50 years old and who would like to roll over 200K from her previous 401k savings. So that 200K in this calculation with the 20% of bonus, account opening bonus, that's 240K. And then each year we'll have the guaranteed 12% year growth on the simple interest rate. So what does that mean? And this 200K in the year 7 is doubled amount to reach to 408K. Also, you look at this column, and this person expects to retire, start withdrawing the money, and when she reaches year 60, 61, and this is the guaranteed income she'll be able to withdraw year on year for her lifetime. So this is one of the rare products in the market because everybody knows that in the market, everything is unpredictable. Nothing is guaranteed. However, this is a very rare product that because the current interest rate very high, also it's a lot of companies are doing the competition. So this is a very good way to consider rollover some of your previous 401k and consider transfer your highly risky portfolio, partial of it, into much more stable guaranteed income. So of course, I'm only giving you an example if we roll over 200K, but if we roll over some higher amount, this amount will be multiplied by different times. So now let's take a look at this in a little bit more details. This is for the first 10 years, this person saves money up there and income basis is growing every year. And every year is 12% of the 200K, which is 24,000. So this person starts withdrawing the money from year 60, and she or he is eligible to start withdraw this guaranteed money until basically the entire lifetime. And the death benefit is depends on the market growth wherever the person is at. So after withdrawing those money, and this person also has pot of money for the death benefit. So now I'm moving on to a different product. This product doesn't give you very high guarantee. It does give you some smaller guarantee. However, this product provides more for the accumulation and growth perspective. So with this, same thing. This person is saving 200K in his or her account. This money comes from previous 401k rollover. And this product has a pretty good, really good way when the market goes negative, and we can guarantee the principal will not be going negative. Well, the market goes up, and this product will have a better return. So all in all, the financial institution assumes market risk. Of course, we're using this last 10 years, actual, the current rates. And the future will not be able to repeat history, but we want to illustrate for you. This is a way to show when you use this product, your money can grow year on year and that give you a potential higher growth and a higher return. And again, this product is annuity, which means that depends on whichever year you roll over the money, when you reach to the retirement age, you start withdrawing the money will help you to have this long-term effect in lifelong income. In addition to it, take a look at this death benefit. Of course, these numbers will not be guaranteed, but still, the money will come to two parts. One is for the annual withdrawal, another part would be your death benefit, whoever the beneficiary would be. And there is another factor is impairment multiplier. If the person in critical illness situation or other critical situation, and this person is eligible to withdraw money double whatever the annual withdrawal amount is. So that's just illustration from over the years. And all in all, I want to mention that this is a really good way to compensate. And the current 401k situation, if we don't have enough 401k savings, or if we don't have enough Social Security savings. So this is a good way and strategy to help us to have more stable and lifelong income. So now let's take a look at when is a good time we'll be able to do this rollover. Whenever we want to roll over 401k, 403b, for the people who work for government and for higher ed, or if we want to roll over IRAs, basically there are several opportunities out there. First, when a person retires. Second, when a person changes job, maybe have a small pot of 401k in previous job, or when a person has previous IRAs in different institutions, either with T. Rowe Price, Fidelity, or different companies. You can evaluate the current performance, whether you're happy with it, And of course, with that, we'll be able to roll over. Alternatively, we can set up brand new IRA, or either just like a new annuity, not using this qualified money, but using our out-of-pocket money to save for your retirement. So in summary, for retirement, the best combination and strategy for the worry-free retirement is number one, to be safe. We really want to have fixed, stable income portfolio. Secondly, we also want to have a portfolio with the higher return. Of course, it's a higher risk, but we really want something will be able to combat the inflation. Also, everybody lives much longer than before. We would hope that we have longevity. Some people history and their family genes can last 100 years, or they can live up to even beyond. So some idea and solutions will be really helpful to help this type of family live very, very long retirement life. Lastly, we have to consider tax benefit, looking at how we save taxes, defer taxes, or completely avoid taxes, and really looking at our current tax rate, future tax rate, and we use different strategies to help us to help consider rollover, to consider conversion, or consider some other ways, however it is, that helps us to have this financial health as well as a better retirement. So with that, I conclude today's conversation. I hope the information I shared with you will be helpful for you, especially for young kids with the custodial IRA. If the kid start earning any money, don't miss its opportunities. Let's save as early as possible. Here is the way how you can contact me. And thank you so much. So with that, we can take any questions.
Yeah, so I have a question for the, so first for the Roth IRA for the kids, they have to earn the income, right?
Correct.
Okay, so if I have a small business, I can pay them.
Correct.
And okay, another question is you showed the insurance, the annuity, right? So if so annuity, they have a limit on your annual withdrawal. And then if you have like a illness, then they increase the limit. And then so-called death benefit actually is the cash, it's the balance. It's not really like a death benefit of an insurance. It's actually the best balance of the account that you haven't.
That's correct. That's the cash value for your account.
Okay, so now the annual withdrawal amount, is this fixed as the contract, or can I say, okay, I'm willing to, withdraw more, and I really don't need a death benefit. My children are doing well, and so I want to withdraw more. Can I do that?
Yes, it depends on different policy.
Okay.
So first of all, this policy is stable. You can't withdraw more. This is the guaranteed lifetime income withdrawal. So this is the guaranteed you only be eligible, like for example, the person saves 200K here, and this person start withdrawing 60 at he is reaching 60 years old. So he can only withdraw this amount. He can delay withdraw. He can delay.
Basically, you're betting with the insurance company that the longer you live, the longer you are, you are better off, right?
Totally. So that's why everybody be healthy, live longer. That's why we want to annuity. Annuity helps us.
So if you die early, then the balance basically it goes to your children, or the balance is like you're gone. You don't get the balance anymore.
It depends. So for this insurance, for this policy, it's insurance company issues this annuity policy, right? And what happens is that depends on this person's longevity and how long the life expectancy. So it also depends on the market. This one is based on moderate, the current rate. And so basically the person would be able to withdraw the money year on year. And so for example, this person probably say 75 has withdrawn accumulated 380K. He only, roll over 200K, right? Over the years, he has withdrawn 380K. And of course, insurance company will look into it. And as the person reaches older age, the death benefits dramatically drop because the risk is much higher, right? So if the person's life expectancy is potentially at 70 years old, so during those time, and this person has withdrawn over the years 261K. And during those time, if the market very similar to the one illustration which I show here, that death benefit still within this account, that shows we have 150K. So no matter whatever, that's the number, during that time, the money will be passed to the beneficiaries.
Okay, so in this case, the so-called death benefit is not an insurance death benefit. It is actually your cash balance.
That's correct.
Yeah, and then, so in this case, there's really no insurance portion of it. It's just investment.
That's correct. That's the investment. However, remember, only insurance company issue annuity products.
Okay.
And annuity is completely correlated to life expectancy.
Okay.
So really, the person is very healthy, have a great lifestyle. The longer the person can live, and the more benefit it's going to be for this person. That's why everybody wants to have some annuity, because no one can guarantee our 401k will be sufficient to last the entire retirement.
Okay, but this one is not going to last for a lifetime. The insurance company is not guaranteeing it.
It
It's
would.
money.
It would guarantee at least to 95 years old.
No, they don't have guarantee. This one is whatever your account has.
Actually, I want to mention one more. This is a guaranteed policy. That's why this amount is not as high, but this amount is guaranteed to 95 years old.
Okay, so this one is different. This one has some kind of insurance, some bedding, okay? So, but the other ones is like a real, this one, no, the other one, the one without, yeah, this one is real investment. There's no insurance portion of it.
This one doesn't give you that guarantee. The guarantee is very small. And I'm running this as current rates, right? But
Yeah,
this policy has closer correlation with market.
Yeah.
So that's why when we withdraw in same situation, but this person is able to withdraw 40K. And you also asked whether this amount can be flexible. Yes, as long as it doesn't exceed, I think 8% or 10% of your total cash value.
Yeah,
and
so
during the year, you'll be able to withdraw higher, withdraw lower, depends on whatever the situation during the year you have.
Yeah, so this one looks like a pure investment. However, I'm asking, why will the insurance company say, okay, I guarantee you no fall, so 0% during negative years. However, I don't give you a cap on the high years. Is it because that's why the performance multiply works? Basically, it says, it's like what does that performance multiply mean? Is it going to be like a credit to you 20%, 30%, 50%? That's basically kind of the cap.
It does have some cap already. When we look at the policy, we need to look at historical, whatever the historical performance might be. But for this policy, it's closely correlated to the market, and it's kind of have hybrid mode, has smaller guarantee, but also has got much long-term, like the potential growth as we go. So that's why it depends on people's interest and also their personal situation. But overall, annuity is a good way. Even when we look at a Social Security, that's also a type of annuity. It's just like societal wide kind of annuity.
Yeah, so help me understand, what does this performance multiplier mean? So are you saying that, if this year it's 70% growth, but they're going to only give you, performance is only 10%. So they only give you 7% credit? Is this what
Well, we need to look at, there are several things which is very important here. One is first, how much money we have rolled over. That's our principle, right? And we also need to look at what will be the account value. That is how much really the cash has grown in the account. Secondly, you also want to take a look at this surrender value. If in any cases we don't want this policy anymore and money still grown in this policy. However, the surrender value will be lower than account value because essentially you just say, I don't want this anymore, and we're going to cut this short, and so you withdraw the money completely, right? So there is no more contract anymore. Anyway, annuity is a contract that's between individual with a financial institution, looking at you can roll over or you can save some money either as one time as single premium or as multiple, and then we'll be able to withdraw the money when we reach to retirement. And there are some good things and bad things about it. Good thing, as we mentioned, that look, the principal has been protected in some way. It's very moderate return, and it's not very flexible. So we will not be able to withdraw the money prior to 59 and a half years old. But it helps us to have this lifelong income, and we'll be able to withdraw the money as we go for the rest of the retirement. So it's kind of like a balance act. And even when we look at a stock, and that may have a higher return, however, it depends on when we enter into stock market, when we exit stock market, right? So that's why we have this kind of like product give us more stability, looking at more guaranteed or have this lifelong income.
Okay, so educate me. This is my thinking, okay, and see, tell me if my thinking is sound and what's some of the holes that you can help me to pick. So for me, what I see this word is one, this word is high inflation word, because of modern monetary theory, there's always going to be issuing money to stimulate the economy, and then the inflation will be always running, the real inflation will run probably higher than the stock market in reality.
Mhm.
So my strategy is always one, I'll take advantage of the tax incentives for 401k. So I'll maximize that. And then on the other hand, in general, even the stock market cannot win the inflation. So I will find ways to take the money out from the 401k to buy real estate or just convert it to Roth IRA. And even in the Roth IRA, I will still want to buy real estate because I found the real estate, one is I can leverage up by borrowing. So as long as I borrow and in the inflation bigger context, the more I borrow, the better off I am. And then the real estate, at least real estate itself, as population grow, as long as I buy in places of growing cities, it will also appreciate. So, and plus real estate is also itself is generating income, so real estate has actually three benefits. One is it generates income. Two is it also appreciates by itself. Three is we have depreciation write-off, so you don't pay tax. Four is also real estate itself, even without Roth IRA, it will continue. You can use like 1031 to escape capital gain tax. Or if it's covered within the Roth IRA, then at least the principal portion is tax-free. So I'm seeing like a really real estate probably is the most winning situation rather than anything in stock market or insurance or anything, all these financial products. What do you think?
Well, I think it depends, and really depends on the situation, also your overall. And for all what we always say, diversity is the best, right? You want to have a portfolio. And
Mhm.
even we invest in real estate, we still want to diversify where we want to invest, what type of houses we want to invest. Yes, not every single house is actually making very good return as we have hoped for. And I have managed for some friends on their portfolio on the real estate. Not every single house is actually doing the best, right? So everything has got diversity out there. But I really I also agree upon with all those benefits you have talked about on real estate
Mhm.
investment, but it's also very hands-on. And so that's a different type of things. And we're talking about investing tangible versus intangible.
Mhm.
And I don't object to invest in real estate, but I'm just saying it's nice to have some diversity.
Mhm.
Also look into if you do real estate, you still need to do ton of research. Some areas real estate is too high already.
Mhm.
So it's too high and your rental return is not as good as when you put in the capital, have to do some calculation, will be return investment overall, right? So
Mhm.
that's why I'm just saying that, there are many ways. And even IRA earlier I mentioned, you can invest in one stock or invest in real estate from your IRA as well. So either way, but if no matter what, number one, we have to agree upon only investment
Mhm.
will be the strategy and help us to
Mhm.
earn more. Not only just rely on our personal active income, but we have to rely on some of those investment income.
Mhm.
And next is what do we want to invest on, right?
Mhm.
That will be a ton of questions and strategies. You talk with different people, they may have different opinion.
Mhm.
And today I'm presenting some financial solutions out there, which is a good moderated way
Mhm.
and to provide and also solve this challenge whether we're going to have this lifelong income. So this
Mhm.
is one way to handle, and particularly when we have 401k, as some of my clients and they have fairly sizable 401k, and
Mhm.
so 401k is fluctuate dramatically, depends on the market. Sometimes it goes really high, sometimes it's suddenly becomes shrinking, depends on market performances. But if you do have those steady income portfolio, that's guaranteed. You know that when you sign this contract, and for example, now it's right here, you sign the contract, you roll over 400, 200k, you know that you're guaranteed you're going to have this amount of income at that age. So for retirement, it's a good thing to have that stability.
Mhm.
But doesn't mean this amount give you the best return, but give you the best guarantee. So that's why we have to evaluate what makes best sense, because even with real estate, everything is aging. And we can fully have these houses potentially over the lifespan. If we get a little bit older house, later on you have to upgrade, okay, roof, upgrade windows, upgrade fences, upgrade tons of other things. So it's a lot, it's very hands-on. So that's why I'm saying it's nice to have both sides and have a very diversified portfolio.
Mhm. Got it. Thank you. So, regarding the Roth IRA conversion rate, so, you give example of, paying tax, when you convert from 401k to Roth IRA. Would it be best to convert during the time there isn't much income, and so you don't have to pay income tax? Or if you have real estate, you do a cost segregation, then you create a loss so that you can offset the 401k income. Would that be good?
Potentially,
Mhm.
I think when you convert traditional IRA to Roth IRA, there will be a tax liability during the year. Because with money, we're having to pay tax. Now we're roll over to convert to this tax after tax format. There definitely will be a tax liability up there. So as you mentioned early on, during the year we have loss, we have cost segregation, we have some other things, and that will probably makes best sense. We don't have to pay tax a
Mhm.
lot, like for that particular year. But we also need to evaluate a couple other factors out there,
Mhm.
such as, hey, what will be my current tax rate versus my future? Am I going to earn a lot more down the road, right? Or am I going to earn a lot less? Also, what age am I in right now? And how long I need to wait for the money to mature. So I think we need to do some analysis, evaluate the situation. It's really person to person, individual cases. But
Mhm.
no matter what, if we decide to convert IRA to Roth, number one thing, you don't want to convert during the year you have very, very high income. You really want to convert during the year you're kind of like making some loss to offset this tax liability when we need to do the conversion.
Mhm. Okay, got it. So also, are you familiar with buying real estate within your Roth account?
Myself, I'm not familiar with it, but I do hear people have done it. You can use it to purchase like, real estate, kind of like they call the REITs
Mhm.
as a financial product. You can also actually purchase real estate. So I heard people have already done it. And I just personally, I haven't done it myself. And I think that's also doable.
Mhm. Yeah, I think the way you do it is you purchase is real estate in the name of an LLC, and then you have the Roth IRA as the owner of the LLC, and then you keep track of the growth, proportionally with the principal and the debt. So the principal part of it is tax exempt when you sell. The debt portion is not tax exempt when you sell the property. Yeah. On the
Yeah,
other
I
hand,
think it sounds right, but I haven't personally
on the
practiced
other hand,
before,
I'm
so I don't know.
thinking,
Mhm.
on the other hand, I'm thinking if it's real estate in Roth, the income will have the mortgage and there was depreciation offset anyway. So there's really no taxable income anyway. And then if you don't sell it, there's no income, no tax anyway. And real estate, you can also do 1031 and keep rolling. So there's never any income tax. You're basically leveraging the IRA account to buy real estate, basically. So whether it's in Roth or without Roth, real estate is still a winning situation. Looks like.
So, Mr. Zhang, maybe we stop recording.
Yeah. Yeah, thank you.